Kerner is the founder and managing partner of the Social Internet Fund, which invests in primary and secondary shares of rapidly growing private technology companies like FireEye, Meetup, Palantir, and many more. Lou is also a partner in Flight VC, a federation of 23 Angeles syndicates, where he manages the Israel Syndicate that invests in Israeli startups through Angeles. Lou, please show us the money.
Okay. Thanks, Yaniv. Thanks, Yaron. It's an honor to be here, speaking in front of this great audience today. I'm here to answer the question, are we in a tech bubble? And I actually created this presentation for the first time in April of 2014. I'm not trying to prove that we are in a bubble or that we're not in a bubble. I want to know myself, so I started collecting data. And what this presentation largely is just a wall of data. And everybody in the audience can draw their own conclusions from it. You know, I'll show you what my conclusions are from the bubble, but I think it's an interesting exercise. But first, I really think, I have to answer the question, well, why am I here talking about a bubble and doing this in Israel? So real quick, by way of background, I used to be an equity analyst at Merrill Lynch and then at Goldman Sachs, following media and technology companies in the 90s. And then in the last decade, I went from being an analyst to actually operating some tech companies. The first company I started was the top-level domain .tv, which we licensed from the tiny island nation of Tuvalu. And then I ran a company called Bolt, which was the largest social network in the world in 2005. We got up to 23 million kids. And about half of that growth was organic. The other half was acquisitions, which is what I focused on. So I talked to over 100 kids, generally 16, 18, 20 years old, about buying their companies. And we did 8 acquisitions of youth-related sites in the 3 years that I was at Bolt. And then I just started angel investing. And in 2009, somebody offered to sell me some shares in Facebook in a secondary transaction. And I had actually been the first person to call Zuckerberg and offer to buy Facebook a couple months after he launched. And he offered to sell me 25% for $5 million. And I laughed in his face. So kind of regret that. But I'd been there since its birth. And I knew what an amazing company Facebook was, but it was valued at $16 billion. And if you read what was said on the internet, it was ridiculously overvalued at $16 billion. And that price was the sign of a bubble. But having been an equity analyst, I was put back on my analyst hat, and there was enough publicly available information that I could get pretty comfortable with the valuation. And I actually thought at that point in time, it was worth $50 billion, and I was shocked. And so I bought the shares, and I actually felt compelled to write my first research report in 10 years, saying it was worth $50 billion, and I thought it would be worth $100 billion in a few years. And because it said former Goldman Sachs analyst and had a $100 billion price target on it, it went viral. And 99% of what was said was highly derogatory of me, but that's okay. It changed the trajectory, though, of my career, and it eventually led to somebody offering to raise me a fund in July of 2012. So since that time, I've made 35 investments in a broad number of internet-related companies that I could deeply understand, whose customers love them. And during this process, I read a book called The Prime Minister. It's about the history of Israel. And it made me want to get more involved in Israel and help Israel and actually start investing in Israel. So I made 2 investments in the fund in Israeli companies, and I was very happy with the experience of both of those investments. And then I saw the rise of AngelList. And I was thinking, gosh, I really, really want to get involved in AngelList. This is the most disruptive thing going on in the VC industry. I wanted a front row seat on that disruption. And then I decided to marry my passion for Israel with my interest in understanding AngelList. And I launched the Israel Syndicate in June of 2015 to invest in companies founded by Israelis wherever they live, whether it's in Israel or New York, San Francisco. We closed our first investment in June of 2015, and I came here for my first time in 20 years to celebrate the closing of the transaction and meet all these people I had been Skyping with and talking on the phone for the previous 6 months. And it was an amazing, amazing week. And I went home, went back to New York, and the following week I published a blog post called Why I'm Doubling Down on Israel. And it's up on Medium, anybody can read it. But the main analogy that I used for why I'm doubling down on Israel was my experience with Facebook. I bought Facebook shares at $16 billion valuation. So I wasn't the first guy that liked, Facebook. There were many, many people who thought it was an amazing company many years before me. But my point at that time, and writing the report, was even at $16 billion, the world had no idea what Facebook was going to do. And that's how I feel about Israel. I'm not the first person to think, to say Israel's an amazing place, an amazing tech ecosystem. But I really believe that as amazing as people, in Israel and around the world think Israel is, the world has no idea, and that's why I'm doubling down on Israel. So, that said, I'm not a wild-eyed optimist. So I actually have a word that I use to describe the tendency of markets to swing between fear and greed, or between bear markets and bubble. And the word I use to describe that is capitalism. And as an analyst, as an investor, I feel, that it's my job to try and understand where we are in that never-ending, pendulum swing. And the only thing that we know for sure also is that the only thing constant is change. And I love this slide because it shows you, this is, it's a little bit complicated. This shows the total market cap of the top 100 publicly traded tech companies. This shows the share of all the different companies. So in 1980, IBM had over 70% of all the share, market cap share, of the top 100 companies. And over time, they shrunk. Microsoft started to dominate in 2000 with 30% share. And today, Apple is the largest company with 20% share. And the only thing that we know for sure is, in 10 years, there's going to be some other companies that don't even exist today that show up on this chart. And as Yaniv talked about, the only thing, we all know what's going on. We have all of these technologies, mobile, social, cloud, big data, all at the same time. Every single industry is ripe for disruption. And as a result, we've seen all these new companies that are now having these massive valuations, unicorns. I mean, the word unicorn was originally coined because billion-dollar market cap companies were so seldomly seen. Now we're seeing them all the time, almost a new one, 1.5 a week. We're on track to create 84 unicorns this year, which is more unicorns than have produced in the 4 previous years combined. And it's not just in the US that unicorns are being produced. Actually, we're on track to set a record for the unicorns produced outside of the United States. Over 40% of the unicorns this year have been outside of the United States. And in fact, I think the new unicorn is not the billion-dollar market cap company, it's the billion-dollar round. There have been 6 billion-dollar rounds this year, which is twice as many private, billion-dollar private rounds as had happened in the history of the world prior to this year. And so it's no surprise that we're seeing the amount of money being invested in private companies by VCs and others, climbing and climbing. It's going to hit $80 billion this year, which is 4 times as high as it was in 2009. And the next wave of technologies are already in place, whether it's Internet of Things, artificial intelligence, that are just going to further accelerate all the disruption that's already going on. And so the question, are we in a tech bubble? Well, there's some classic ways to see if we're in a tech bubble. One of them is, where are MBAs going? Because wherever they're going, that's probably a bubble. And this year, in 2014, last year, set the record for the percentage of MBAs in the US that went into tech companies at 20%. But I'm not looking at anecdotal things. Let's look at some hard numbers about what's going on. So what's going on in the public markets? If you're to go back over the last 5 years, the NASDAQ has appreciated at 14%. That compares to over 44% a year that it appreciated in the 5 years prior to the peak of the bubble in 2000. So, 14% is pretty heady. Nothing at all like what happened in 2000, though. But 5 years ago, we were just coming out of a very severe recession. If we went back further, if we go back 10 years, the CAGR for the NASDAQ was 8%, as opposed to 27% for the 10 years prior to the peak of the last bubble. And 8% is actually lower than the 45-year historical average for the NASDAQ gain. So from that perspective, it actually, the market kind of looks like it's, on track. But if you're going to look at valuations, you start to get a different picture. And there are lots of different ways that you can look at the public market valuations. I have a couple that I really like. One is the CAPE ratio. And CAPE ratio was originated by Robert Shiller, who's a Nobel Prize-winning economist. And CAPE stands for Cyclically Adjusted Price-Earnings Ratio. Because there's so much variation year to year in the price-earnings ratio, this is a 10-year average, inflation adjusted. And if you look at this over the last 100 years, we're actually at the third highest point in the history of the CAPE, and we're 50% above the long-term average. So looking at this, it looks like actually the public market is actually pretty stretched. The other indicator that I like is what's called the Buffin Indicator, which looks at the total market cap of the Wilshire 5000, which is a very broad way to look at the market, and it divides that by the total gross domestic product of the United States. And if you look at it like that, this is actually 70% above its long-term average. So looking at these, at these traditional ways of valuing the market is stretched. If you look at technology companies in the public market as a percentage of technology stocks and look, are they overvalued? I think this is a really great graphic that shows the percentage of market cap that technologies make up of the S&P 500. And as you'd expect, it climbs over time because obviously technology is becoming a greater part of the economy. And if you look at the trend line, you can see how far above the trend line we were in 2000. Today, we're right along the trend line. So what the data shows me is the public markets are stretched, but the private markets are actually, but the technology companies within the public market appear to be fairly valued. But what's going on in the private markets? Because a lot of people even say, there's not a bubble in the public market, but there's a bubble in the private markets. And the great thing, and here in Israel, both the number of deals and the number of dollars being invested are going up. And a lot of statistics here I'll blow by. In the U.S., what we're seeing is the dollars are still going up, but the number of deals are going down. So what's happening is more deals, more dollars are going into each deal that are done, particularly the later stage deals. 100 million plus deals, the number of 100 million plus financings has doubled over the last year and continued to climb. This is just through the second quarter. They just released a few days ago the third quarter statistics, continuing to climb. And valuations at these late stages, are soaring. And that's in part because we're seeing a bunch of new investors come into these late rounds. Companies like Fidelity and Wellington that traditionally invested in public companies are now investing in private companies because if they don't, they're going to lose out on the alpha they got when those companies went public at 100 million and now are coming public at 5 or 10 billion. But valuations are also rising at the earlier stages, just as fast as in the later stages. And in my mind, one of the things that really says that we're in a bubble is prices keep going up and up and up. And at the same time as prices are going up and up and up, the investors who are buying, as much as they like the company at $20 million, that same company, they like even more at $40 million. And what we're seeing is at the same time as prices are going up, investors, particularly in the US, are becoming more positive about the investing environment. So the US is where investors, this is the results of a survey of 280 venture capitalists around the world. They're most excited about the United States, second most excited about Israel, but broadly across the markets, more excited this year than they were last year. And this is just a month old. We're also starting to see a lot of new entrants. I showed in the later stages. We're seeing a lot of new entrants also in the earlier stages through crowdfunding platforms, including our crowd and iAngels, our great platforms here in Israel. My syndicate is part of AngelList. And these slides, if you go to angellist.com and go to their blog, you can see these slides. So I'm going to blow by these very, very fast because only have a few minutes left here. But AngelList is the world's largest marketplace for startup investing in jobs. Over $200 million has been raised by AngelList over the last 2 years for companies. And it's largely through syndicates. They have 165 active syndicates now, over 4,400 investors who have actually invested in startups through the AngelList platform. So that works out to an average of more than 40,000 per investor. So they're not just investing 1,000 or 2,000, but many are 100, 200,000 or more. And I'll blow through these slides. It's interesting that it's also now, the ecosystem has grown, that it's not just individuals, but there have actually been funds that have been formed that are now investing through the syndicates. So when I closed my first deal on AngelList, the first email I got when it closed was from Maiden Lane, a $25 million fund that said, we see that you're active now on AngelList. We'd love to see all your deals. We invest on average $250,000 in every deal we invest in. And it's not just these funds, but last week AngelList announced a $400 million investment from the third largest private equity firm in China. So as fast as AngelList has been growing, it's going to grow even faster in the coming years. My syndicate is part of a federation of 23 AngelList syndicates called Flight VC. We have syndicates like the Internet of Things, SaaS syndicates, Bitcoin syndicates, and then some geography syndicates like the Israel Syndicate and the UK syndicates. We have over 3,300 backers across our syndicates, over $20 million raised from the syndicates. And we think we're going to change venture capital through Angel Mob, which we have over 3,000 investors today, over 10,000 investors, we believe, by the end of next year. And Angel Mob's a platform that we're developing to leverage the wisdom and contacts of the crowd to help the companies we invest in. And we think we could be the most value-added investor in the planet if we can actually get Angel Mob right. So I've talked about the amount of dollars going in to companies is going up, but the amount of dollars coming out through M&A and IPOs, not so much. Israel's doing really well in terms of the number of M&A deals, but the US, the number of M&A deals are down 20% year to date, and I think that's likely to continue to decline because last quarter for public companies, the stocks went down for the first time in 12 quarters when they announced a deal. So if you're a public company, at the margin, you're less likely to do a deal if your stock is going to go down. IPO volume, which had been going up over the last 5 years, is now down 55% in the United States. And so, and that's because the performance of the IPOs have been so poor. If you invested on the first, if you got in at the IPO price of IPOs in 2015, you're up 3% on average. But if you bought first day, at the first day closing price, you're down 15% on average. So it's no wonder that investors are losing their appetite for IPOs given the performance. And in fact, now investors are asking if IPOs are the new down round. We've seen multiple companies that have come out and IPO'd at prices that were below their last private round. And M&As can be down rounds too. BlackBerry recently bought Good Technology for $425 million, which was below the $1 billion round that they had previously raised money at. And so what we're seeing now is money coming in continues to grow. Money coming out is going down. And for the first time in many years, we've seen more money coming in than going out. And at the end of the day, that's not sustainable. So in my mind, this is one of the most worrisome slides in the entire deck. This can go on for a little while, but eventually investors want their money back or they're not going to keep on investing. And the last thing I want to touch on, I've talked about public markets, private markets. What's the interaction? This is like an Escher drawing that shows, that public markets inform private markets and private markets inform public markets. And in fact, there was a recent blog post saying either private companies are overvalued or public companies are undervalued. And in my mind, that's, asking that question is like asking, either my watch is running fast or Greenwich Mean Time is running slow. Greenwich Mean Time is how we set our watches, obviously, and public markets is how the private markets should set valuation as well. Because investors pay for liquidity, and obviously there's no liquidity or there's limited liquidity until an M&A and IPO in private companies, but you can sell public companies anytime. And that's the major reason why they're worth more. And Fred Wilson recently said, I think the tech sector is making a huge mistake thinking they know their companies and how to value them better than Wall Street. That kind of thinking is arrogance and pride comes before the fall. I realize that investors often get downside protections and even upside guarantees. It was just announced a couple days ago that Square investors got guaranteed a 20% return on the first day of the IPO. So however many shares they have, they'll just get more shares if the IPO price is below where they invested at. So, when we look at these figures and look at valuations, we all obviously have to keep that in mind. So the last slide of data that I have is looking at the multiples for all of these private companies. Uber at 100. And these are all obviously just estimates. These are by CB Insights. But you see all of these dramatic revenue multiples, and then you compare them to the revenue multiples of the largest, most successful public companies, and they're just out of whack. So that's all the data that I've got you for today. The last question is, are VCs making bad bets on unicorns? That's the question that I get asked the most. And the truth is, as Warren Buffett says, you only find out who's swimming naked when the tide goes out. And eventually, the tide is going to go out. Thank you.